Okay. Okay, so this is the vBON. It is Friday, the 12th of September, 2025. Since Roman times, we've paid taxes, and let's be honest, not much has changed except the paperwork and the penalties. Back then, it was a scroll and a soldier. Now it's a spreadsheet and a deadline. Thankfully, today we're joined by someone who makes tax returns feel less like a gladiator match and more like a well-oiled process. If you Google him, and I did, here's what you'll find. Rory is a trusted personal and business advisor with over 25 years experience within practice and provides a personalized value-added audit, taxation and financial service to the firm's broad owner-managed and family business client base and advises clients on key aspects of their development. In short, Rory Williams knows how to make tax work for your business and not just the revenue. You can find him at rorywilliams.ie, but for now, we're lucky to have him right here. Rory, over to you.
Jesus, no pressure after that. Thanks, Chris. I'm going to try to share my screen. So apologies when I display, firstly, my lack of computer skills. So bear with me while I just try to share screens here.
Can I just ask that everybody goes on mute, please? Thank you.
Right. So hopefully you just see a screen of a picture, yeah, if you have it right. Yeah. Okay, perfect stuff. Okay, so the first thing I want to show to you before we even get into that is this. This is if you've seen it, it's the income tax return, and it's 44 pages long. It has loads and loads of bits to be filled in, and if you don't fill it in correct, it can come back to haunt you. The idea, as I try to move along my little screen here, bear with me, page down, there we go. So yeah, so if you're a bit like a penguin and you're trying to figure out what to do, today's plan is to show you how to simplify your tax and avoid traps. So in this, I've set out 21 traps you can sometimes have in your tax return. There are loads, and I'll tell you some of them. This started off being a replication of a presentation done a number of months ago, when I did say the benefit of doing a tax return early is you know what you owe when you owe it, and you've months and months to plan your cash flow. So even though the tax filing deadline is coming up in about 2 months' time, it's still not too late to do it now and to have 2 months to plan your cash flow. Maybe talk to somebody like Paul in terms of putting money into a pension. Maybe talk to somebody like Denise in terms of how you collect in your cash to pay your tax. I'll mention there a 4-year rule, which I'll come to later on. But the first thing is, what I call the first trap is not filing a tax return. So the question is, do you have to file a tax return? And basically, to file a tax return, it applies to somebody who is self-employed. It applies to somebody who's a proprietary director, who's somebody who owns more than 15% of a shares of a company, and we'll talk about that in a moment. And people with other income not taxed through the PAYE system. So the obvious thing that people think of is people with maybe rental income or maybe investment income, or other side hustle income where they're making their fortunes. And if your non-PAYE income that hasn't been taxed through your salary is more than 5,000 net as a profit or 30,000 gross as an income, you are within the self-assessment system, which means you have to file a tax return. If it's less than those amounts, you still have to tell the revenue, you still have to pay your taxes, but you're not within the self-assessment system. And I'll tell you what the difference is for you with that. The main thing, though, if you are a company director, is to remember that even if all of your salary is taxed through the PAYE system, you still have to file a tax return. And people who have recently become directors will often not realize that, because they'll think, oh, I've paid all my taxes. And the problem is, if you don't file your tax return, then you are subject to a surcharge, penalty, and interest. And for a company director, that's calculated before taking account of your tax that's been deducted on your salary. So it could be quite penal, because if you file your tax return 2 months late, you have a 5% surcharge. after 2 months, it's a 10% surcharge. So you could be into thousands and thousands of euros. And I've come across cases where people didn't realize this, they get hit with surcharges, and then you're going to the revenue with a Kleenex box and a sob story and hoping that they'll be generous and waive the penalties. So when do you have to file? The main deadline is the 31st of October. This extends by approximately 2 and a bit weeks to the 19th of November if you file and pay online through Ross. So by that time, you have to file your tax return for last year, pay whatever balance of tax you have for last year, and pay tax on account for the current year. Now, if you come to me and you say, Rory, that's all well and good, you've done a great job, you've worked out how much tax I owe, but I don't have the money. And Denise has done her best, and my clients still haven't paid me, and I still don't have the money. What I would be saying to you is, even if you don't have the money, file the tax return by the 31st of October. At least then you can't be hit with a surcharge for late filing of your tax return, which could be up to 10% of the liability. Then it's more just a collection issue for the revenue, as in you now have a debt with the revenue and to the tax to be paid, but you have avoided the surcharge that would arise from putting your head in the sand and not filing your tax return. We'll talk about preliminary tax, but basically if you don't pay sufficient preliminary tax, you can be hit with interest. So if, for example, for 2024, last year you didn't pay sufficient preliminary tax, the revenue could look for interest from you backdated to 31st of October last year for your underpayment of tax. And they are being more aggressive on that. For years, they never really looked for it unless the amounts are very big. But in the last year or two, they are literally hounding people for interest. So what are your options for paying your preliminary tax? And this is the trap, that you don't pay enough. So you can either pay 90% of what you think your liability is going to be for this year, and that's after taking credit for any tax deducted in your salaries and so on, or you pay an amount which is at least 100% of the previous year, and that's generally the most popular one because it's a known amount. There is also one called the 105% basis, but not many people, to be honest, use that. But sometimes people will, but you have to set up a direct debit, and you'll have to have set it up months and months ago. So the main thing is to pay enough. And sometimes if people don't pay enough, they will end up going to somebody like Paul at this time of year, put an extra amount into a pension to reduce their tax liability, and thereby end up coming within the 90% of the final liability version. Mentioning Paul and pensions, if you put money into a pension by the tax filing deadline date, whether that's 31st of October or the 19th of November, you can elect, if you wish, to set that back against your 2024 tax liability. So in a simple example, if you put 10,000 into a pension and you had a 40% marginal tax rate, that would reduce your tax liability for 2024 by 4,000 euros. It would reduce your preliminary tax for 2025 by 4,000 euros. So for an extra 2,000 of cash flow, you have 10,000 in your pension. Now, obviously, in a year subsequently, if you don't put money into a pension, you will have a higher balance at that stage. But as an immediacy, for not much additional cash flow, you can start building up your pension nest egg. If you don't pay on time, revenue look for interest at a rate calculated daily, which is effectively 8%. That interest is not tax deductible for a business. Some people, when they're cash strapped, will consider it just a cost of doing business, as in, I have to pay the revenue interest, so be it. Otherwise, I have to pay the bank an overdraft rate of interest. But at least an overdraft rate of interest on your business bank account, you get a tax deduction on it, whereas revenue interest, you don't. As I mentioned earlier, if you don't file on time, you can be hit with a surcharge, which varies between 5% and 10%, depending on when you actually file your tax return. And as mentioned earlier, for directors, it's calculated before crediting your PAYE deducted. Just as a general oversight as well, sort of in terms of red flags, if you file your tax return late, if you don't pay your tax on time and this kind of stuff, it's all little breadcrumbs of red flags that ultimately would raise you up the pecking order of the revenue deciding, let's go and have a look at such and such's affairs, because maybe there's an overall issue that we need to look at, and you end up getting selected for a revenue audit, which is like having a root canal. It's not exactly an enjoyable experience. So then the next trap people have sometimes is they have the incorrect basis of assessment. So there are various bases of assessments. I won't go into them too much, but sometimes something will happen where somebody dies, somebody gets married, somebody separates, and they don't let the revenue know, and it impacts on how their tax liability actually works. Another trap that sometimes people fall into is they pay too much PRSI. They don't tell their employer their age because they're afraid they'll be suddenly retired or something. But if you're over 66, you can your PRSI rate changes. Similarly, if you're in what's known as a family employment, it's not a PRSI-able employment. So, for example, if you had a self-employed individual and they employed their spouse, that spouse is not a PRSI-able employment. So there's two things. One is you don't pay the PRSI, but the second one is you might want to become a voluntary contributor so that you have your stamps for your old age pension in the future. And also there's benefits from being a full medical card holder in terms of rates you pay. Residency status, I know we have a few people coming in this morning who may or may not have Irish tax liabilities, but if you are what's called not Irish domiciled, not Irish ordinarily resident, it can impact on your tax liabilities for income tax and capital acquisition tax. I won't go into it in much detail, but there is some tax planning you can do. There is some gift tax things to be aware of if you've just come to Ireland and you're not Irish domiciled. You've sort of a 5-year window for it not to be an issue, but after that, it would be an issue. A big one that people sometimes fall into if they have rental income is they haven't registered the tenancy with the Residential Tenancy Board. I'm not too sure how much the registration fee is. I think it's about €100 or give or take. But if you haven't registered with the RTB, you're not allowed to claim a tax deduction for interest on your loan against your rental profit. So you could have 10,000 of interest on a loan that suddenly you don't get a 5,000 euro tax deduction because you didn't register and pay €110 or whatever to the RTB. And also, as I've always say, revenue don't come to you on a Monday and say you did something wrong on Friday. They'll come to you a year or two down the road. They'll look for their interest, their tax, their penalties, the whole shebang. So, it could be a ticking time bomb that you're not aware of. So if you have residential investment properties, make sure they're registered appropriately with the RTB. Without getting into the huge details, there are various expenses that you can claim against rental income. I've set out some there, and anybody who gets the slides later can look at them. One that people often overlook is if they have mortgage protection insurance premium. One that people often mistake is they can't claim for their own labour. So if you go and paint your rental house, you can claim for the paint because you bought that in B&Q, but you can't claim for your own time. Whereas if you hired Bob the Builder or Bob the Painter to go and paint the house, you can claim for their time. There are some employment-related deductions and reliefs you can get. Some are industry-specific flat rate expenses. So, for example, if you were a nurse, for example, you can get a deduction of a couple of €100 and it's meant to cover the cost of you laundering your uniform and that kind of stuff. And there's about 3 or 4 pages of industries and sectors that are covered. So generally speaking, you'll be aware of it if it does apply to you, but sometimes people don't. So it's worth having a look at the flat rate expenses, and I can send you the link if anybody's interested. If you're working from home, which some of us still are, there is a remote working relief where you can get a proportion of your utilities and broadband as a deduction. Generally speaking, I've seen it works out at between €100 and €200 in terms of hard cash as to what it's worth with people. Revenue, do review it, do look for backup. There is a small benefit exemption, more for the employer to decide to give to you. So if you have your own company, make sure you claim it. If you have your own company, does your spouse or partner work in the business? And consider that, because you can give them a salary, a pension, that plants the seeds for future ex gratia tax-free payment to them, and they can also get the small benefit exemption. Key thing for the small benefit exemption, which is up to €1,500, is you have to be on the payroll. You can't be not on the payroll and get that, and people quite often forget that. Then another trap is kind of thinking, well, sure, it's all taxed anyway, isn't it? So, dividends, you have some dividends or you have some interest, and you say, well, sure, it's all taxed anyway. It still needs to be returned on the tax return, and there might be a small balance to pay because the revenue want their extra pound of flesh. Then you can be thinking insular, you could be thinking Ireland and forgetting about non-Irish income. So, for example, if you had a rental property in Portugal, for example, I'll just mention Portugal because Alex has gone to Portugal. But supposing you had a rental property in Portugal, you might think, oh, well, sure, I make a tax return in Portugal for that. I don't have to include it on my Irish tax return. You do, because in Ireland, if you're a resident here, you are taxed on everything. So you need to tell them about your foreign income as well. And every so often, the revenue will do a little investigation, and they'll find people have maybe a UK pension or a US pension and they haven't returned it. And they basically go after those people looking for money. Then, as much as having income, it's forgetting to claim an exemption. So, okay, artists and woodlands is a bit obscure, but if you're renting out the box bedroom in your house and you can get up to 14,000 tax-free, for example, you need to file a tax return and you need to disclose it and claim the relief. Or if you're carrying out childcare services in the house, you need to disclose it. No extra taxes arising, but you have to disclose it. And as part of the revenue, follow the money principles. And then, forgetting to claim things. And I've put there to the right, to the 4-year deadline to claim. And there's been many cases gone to the tax appeal commissioners about people going, mea culpa, I forgot to claim, can I amend? And the answer is always no. Legislation is you have 4 years to claim. So if when you're doing a 2024 tax return, you suddenly find something that would amend your 23 or your 22 or your 21 tax return, it's not too late to claim it. So, medical expenses, people quite often will, leave it too late to claim it and say, oh, I'll do it later. So if they calculate it all up, they can get their tax back. They get 20% tax back on medical expenses. They get their marginal rate of tax on nursing homes, which I've completely misspelled there. And it can add up. So if you go to the same doctor, ask them for a statement. If you go to the same pharmacy, ask them for a statement, and it gives you the amount, you get it back. Reliefs that have come in recent years that people may or may not be familiar with. There is now a mortgage interest tax credit where they look at the interest you paid in 2024 compared to the interest you paid in 2022. If you've paid more, there's a bit of a tax relief you can get. If you are somebody whereby your spouse is a stay-at-home spouse because they're minding a child, then there's extra tax credits and tax bans that you can get. But people sometimes just don't realise it and don't claim it, and the revenue don't know that there's a child or 2 or 3 or 5 at home, and therefore they don't give it to you. So you have to claim it. If you're in rental accommodation, you can get a bit of a rental tax credit. Income protection, again, something that Paul would probably talk to you about, which helps to protect your income. Pensions, they're all tax deductible. Tuition fees, if you have full-time, part-time colleges, fees for you or your dependents or your kids, so everyone's back to college this year, there are things you can claim. If you're in the situation where unhappy differences have arisen and you're either receiving or you're paying maintenance payments under a legally enforceable agreement to your former spouse, then there are tax implications on those payments. If you're making payments to your spouse versus payments for your children, there is a difference in their tax treatment. So just to be aware of that. Forgetting to disclose chargeable assets, again, this doesn't trigger a tax liability, but it's all part of the revenue just trying to follow and build up a picture for you. So if you bought shares, if you bought a house, if you sold a house and bought a new house to live in, you'd be sort of saying, yes, I bought a new house, and you'd be just putting in the amount. If you were in the lucky position to receive an inheritance or a gift, On the income tax return, you just tick the box to say, hey, I got a gift. That's it. Doesn't trigger a tax liability here. Separately, you may have a form to fill out. And when you have to file a gift or inheritance tax form, it's when you're over 80% of the threshold, or if you're claiming certain reliefs, or if the revenue asks you to file a tax return. The CAT returns run on a different time frame. So while the tax year is the calendar year, gift or inheritances are based on a August year-end basis, but the tax filing date is the same as the income tax date, which is the end of October. To our thresholds, depending on who was the person who gave you the money. So, from parents, Group A, it's 400,000. From brothers, sisters, aunts, uncles, 40,000. Strangers in blood. So if Chris decided to give me money, he could give me up to 20,000. And if I haven't received anything from any other strangers, I wouldn't have to pay any money on it. Forgetting about capital gains tax. So you were in the lucky position of having a few shares. You sold them. You made some money, and then you don't tell revenue about it. So first off, you have to pay tax by various dates as set out on the screen, and secondly, you have to put it on the tax return. The revenue have recently made a pronouncement that basically, if you don't put it on the tax return, you haven't made a complete tax return. The implications for that will be that, generally speaking, where I talk about you can go back 4 years if you've forgotten to claim something, generally speaking, the revenue can only go back 4 or 5 years to come knocking on the door for you, unless they consider you haven't made a complete tax return, or it's an absolutely huge fraud and negligence. But generally speaking, after 4 or 5 years, the revenue can't come to you. But if the revenue can open the door for them to being able to go back to an earlier year, because they say, oh, you didn't tell us about the capital gains tax, so therefore your 2020 tax return wasn't complete. So because it wasn't complete, the clock for 4 years or 5 years for us to be able to raise an assessment on it didn't start, because you didn't actually make a complete tax return. So what happens when you file a tax return? Hopefully you won't get a visit from the revenue with their friendly Lucille. But it is part of the self-assessment system, because what you file, the revenue take in theory in good faith, they put it into the systems, they'll randomly query some people, and they may come out and look for other things. It's not the end of the world, but the main thing is to be ready. Just because you file your tax return doesn't mean you don't keep your records. So you need to keep your records, keep them for 6 years, just in case somebody knocks on the door and looks for the backup. And that's the next thing that people forget to do. So there's many ways you can keep your records. There's literally the back of envelope, piece of paper. You can keep it in an Excel spreadsheet. Nothing wrong with it. A lot of businesses do it. But as you get more developed in business, maybe look at a computerized system like Xero or similar. They can be very useful, because they can link to bank accounts, pull it in. They can send out invoices. They can send out statements. And if anybody wants a demonstration of Xero, I can give it to them. But remember, you need to keep your receipts. You could manually store them and keep them in an envelope, but to the risk of a loss, you can scan them. Just keep your scan, keep a backup of your scan, keep a backup of your backup. Or again, in something like Xero, it's all integrated and it's all in there and linking to your bank account. So if the revenue come knocking on the door and you don't have the backup, they will basically assume you didn't have it, unless you can absolutely prove otherwise, and that'll be just a painful exercise and lesson. Trap number 20 is basically, if in doubt, get tax advice and get the correct tax advice. I have many people who come to me and say, I was speaking to a guy in the bar, I was speaking to a guy in the golf club. And sometimes, yes, in fairness, they might get good advice, but quite often it is, I'll say, Trump-esque in its style of tax advice. So, talk to a tax advisor if you have any concerns. Even if they just say, yes, you're fine, at least that gives you peace of mind. And then the last trap I just put here for more mischief more than anything, and apologies to Raymond because he's not here, was just not having me as your tax advisor and accountant. But other than that, that's a whistle-stop tour just through a tax return. I don't know what else you want to say. I can answer any questions if people want to be muted, or people want to call me afterwards, because sometimes people don't like talking about money and talking about their personal affairs. But if anybody has any questions, feel free just to drop me a mail or just give me a call afterwards, and no obligation, I'll have a chat with you.